Recently, Malaysia's largest EMS company, VS Industry, reported its worst quarterly results and saw its share price plunge sharply. This is largely due to a higher than expected US tariff impact. However, Malaysia's tariff rate is not higher than our peers. Thus, we are not disadvantaged. Why then are our manufacturers so heavily affected by the tariff? The issue lies in who ends up bearing the cost. As tariffs kick in, US companies grow concerned about consumer demand. To protect sales, they avoid raising retail prices, choosing not to pass tariff costs on to consumers. But they also don't want to absorb the whole tariff cost themselves. So instead, they shift the pressure to their suppliers, pushing manufacturers to lower their prices. This puts manufacturers in a tough spot, either accept lower margins to keep their contracts or risk losing the customer. This is especially true for sectors where there's excess manufacturing capacity among the suppliers. Like in the case of the EMS sector, if VS Industry doesn't accept a lower selling price, another manufacturer may. This dynamic could weigh on manufacturers' earnings in the coming quarters. When will it get better? Or will it worsen? A key factor is the strength of US consumer demand, and whether the consumer is willing to accept higher prices. Recent surveys show US consumer sentiment is still relatively soft. Yet, retail sales data have been surprisingly resilient, coming in better than expected. To explain this, several reports suggest that the spending strength is concentrated among higher income groups, while lower income households remain under pressure. This is partly due to the wealth effect. The US stock market is booming, which makes wealthier consumers feel more confident in spending. And higher income households have a disproportionately high stock ownership. But with the market now trading at a record high valuations, the risk of a pullback is high, and that could affect future consumption. But at the core of it, the real squeeze comes from Malaysia's manufacturers' lack of pricing power in a competitive environment. Firms with low technological barriers that can be easily substituted by competitors are under the greatest pressure. These manufacturers have little leverage to push back against US customers, especially when there is excess capacity. It forces them to absorb a larger share of the tariff burden, which directly eats into margins. And margin pressure may persist unless US consumer demand strengthens and are willing to accept higher prices, or manufacturers find ways to lower their cost.